Ashish Shanker, who's the MD and CEO of Motilal Oswal Private Wealth. Good morning, Ashish. Thanks a lot for joining in. Before I come to, talking about themes and what should one do with their portfolio at the current juncture, I want to get in your thoughts on where the markets are headed and what the next big trigger would be, given the fact that we've come off quite a bit from record levels, 3% off from there, and we've seen quite a few, in fact, we've seen a lot of volatility in the markets at the current juncture. So, where do you think we are headed from here?
Yeah, hi, Nandita. Happy to be with you today morning. The time frames that we look at equities is very different to probably a trader. I mean, typically we allocate monies for HNIs, ultra HNIs with a 3-year plus perspective. So if I look at it from that lens, in the near term, yes, the markets have run up and they've not run up on liquidity alone. I mean, the fundamentals have kept pace. I mean, I'll just give you a perspective. September 2021. The Nifty was around 18,000 plus levels, and today you're at 19,400. Today you're at least 25% cheaper on a fundamental basis than you were at 18,400. So earnings have gone up 30% during this period, whereas markets have broadly remained flat. So actually, fundamentally speaking, the markets are still attractive. Having said that, the kind of run-up that we've seen over the last 3 to 4 months, I wouldn't be surprised if markets do take a breather here over the next few months. So what we are telling our clients is, if you want to build incremental allocation, you could probably stagger it. And from a, trade-off point of view, large caps are looking probably more attractive than mid and small caps. We've seen a very sharp rally in mid and small caps. But if you take a slightly longer lens, Nandita, of a 2 to 3 year point of view, I think there is a lot of upside left. I mean, if you were to become as expensive as you were in September 21, that level corresponds to about 27,000 of Nifty. So I'm not that worried.
All right. So, you said that large caps still have a lot of potential here on. Do you think one should look at multi-cap funds at the current juncture now, Ashish?
Yes, you're right. The multi-cap funds make more sense because they're or multi-cap or even flexi-cap funds, Nandita, because flexi-cap funds have the flexibility to decide whether they want to invest in larger companies, medium-sized companies, or smaller companies. And that flexibility rests with the fund manager. So it is better to go into flexi or multi-cap funds. Multi-cap funds have a restriction. They can be 50% in large cap and rest, they have to be in mid and small cap. They're also not a bad option, but flexi-cap funds, according to me, come up on top of my recommendation list at this juncture.
All right. Looking at somebody's portfolio, what kind of a construct should one have? How much of an exposure should one have to fixed income products, given the fact that, rates are, higher rates are here to stay rather. That's what, global central banks are saying. And in fact, even we are looking at a longish pause, given the fact that inflation is once again heading higher. The timeline for a rate cut by RBI perhaps may have been, delayed by another quarter or so. So, how much of an exposure should one have to fixed income products aside of equities, and how much of, exposure should one have in gold at the current juncture?
So, all interesting questions. And the best part right now is, all asset classes are looking reasonably attractive. I mean, if you look at fixed income, like you rightly said, our view is similar. We believe that rates have topped out, but at the same time, we don't believe rates are going to fall in a hurry. So a fixed income portfolio will give you very good yields today. A basic high quality bond can give you between 7 to 8%. I mean, if you venture into the structured debt space and are willing to take a little more credit risk, then you can go into the double digit territory. Having said that, Nandita, for investors, you also have to look at your post-tax return. What has happened is post this budget, the taxation benefit on fixed income funds has been taken away, the long-term taxation benefit. So we are recommending hybrid funds. So there are conservative hybrid funds and there are aggressive hybrid funds. So the aggressive hybrid funds are these balanced advantage funds, which can straddle anywhere between, they can go from 30 to 65% equity exposure. Then you have these conservative hybrid funds, which can be more than 25% in equities. So those offer you much better tax benefits than, let's say, a pure fixed income fund. So we are definitely positive on fixed income. Coming to gold, again, gold, we are recommending that you must have an allocation to gold in the portfolio because, I mean, fundamentals in India look pretty good, but globally there is a lot of, if I may say, uncertainty. I mean, you have China slowing down sharply, you have challenges cropping up in US, and then the Europe situation. So things are going to be pretty challenging. So a multi-asset class today, multi-asset portfolio offers the best risk return trade-off. I mean, we have a portfolio that we run, Nandita, where we basically allocate equally to each of these asset classes. So 20% gold, 20% Indian equity, 20% foreign equity, 20% fixed income, and 20% cash. That portfolio actually has done the best over the last 2 to 3 years, and I think it will continue doing extremely well. So 40%, 45% equity allocation is a great allocation. But then I must just add a caveat that, these allocations are very customized in our case. Every client is different. So depending on the conservative or aggressive nature of the appetite, we would tailor the portfolio. But 40% equity is a great allocation to be with currently. And I would say that, having your foot in different asset classes today makes a lot of sense.
40% exposure to equities, but would you prefer any kind of theme when it comes to investments at the current juncture? Street is a little pessimistic about IT stocks, but do you think it's time to buy into the fear?
Look, our view has been very clear over the last couple of years, and I think that trend continues. The world as well as India is underinvested in physical capex in the last decade. So we see a lot of activity around manufacturing. Real estate as a sector has picked up quite well. I mean, quarter on quarter, you're seeing all-time high volumes in terms of units sold. You are seeing a lot of action from government to improve the infrastructure and railways, improve the road infrastructure. So I think, investment-related companies clearly stand out, and I think they will do well over this decade. When I say investments for families, it is real estate is the main capex. So I think stocks around this sector will definitely do well. But at the same time, discretionary consumption is an evergreen theme in India. I mean, as per capita moves up and more households come into the middle income category, you will see a lot of categories do well. But discretionary, aspirational is the way to go. As far as IT is concerned, Nandita, I know the stocks have come off. But when I look at valuations and when I look at the kind of uncertainty that is there in the broader system, whether it's US, Europe, I would say it's still not like a no-brainer buy. Last year banks were somewhere in that zone. Banks were extremely attractive. But I guess it'll take a little more time for IT stocks to become really attractive from a fundamental basis. I mean, you might have a bounce back because the stocks have been beaten down quite a bit, but I would say that they're still not cheap.
Right. So there is room for more downside in IT stocks. That's what you're saying, right? Ashish, so are you saying there's room for more downside in IT stocks from here? If they're not looking as attractive as you would expect it to?
Yeah, see, there are two ways this can go, right? You could see the stocks being flat for some more time and earnings might catch up. Because see, we are still not calling for a degrowth in earnings, right? What you're saying is that, if IT stocks had earnings growth of 12 to 15%, you're probably looking at a single-digit kind of earnings growth. So if IT stocks don't go anywhere, let's say for the next 8 to 12 months, you're automatically becoming cheaper by 10, 15%, and then they start looking attractive again. Or if there is some kind of an event which happens in US or some trigger and IT stocks do correct, 15, 20% from here, then they become attractive. So there are two ways this can go. But I would wait it out and not try to second guess which way the stocks are going to move. I mean, rather watch fundamental valuations. And if it does correct by another 20% odd from here, then it just becomes attractive. So I would keep the stocks on the radar. I mean, you choose which companies you like and probably wait it out for a while.
Wait and watch approach for the IT pack as of now. With that, Ashish, thanks a lot for taking out time and joining in and sharing your insights with us. It was a pleasure speaking to you this morning.
Thanks, Nandita. Have a good day.
You too.